Infinite banking. Why should I pay to use my own money? Actually, whenever you use your own money, pay cash, write a check, you do pay for using it. I'll get back to that and explain it in a bit. But first, in the case of infinite banking, when explaining how taking policy loans lets you use the cash in your life insurance policy to finance things, and how with the right company you'll always earn more interest than what you pay for the policy loans, I often get the question, well, why should I have to pay to use my own money? Yeah, well, often that question is delivered with a tone of indignation, like, hey, it's my money. Nobody has the right to charge me for me to use my own money. I understand how that thought can give pause, but that's not really what's happening. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the marketing director of the Hawaii Financial Free Thinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and the tax-free cash growth warehouse finance strategy. And if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here and share this video and this channel with your friends and family and coworkers and so on. If you have questions, we have answers. Okay, so there is opportunity cost, or more correctly, lost opportunity cost. And there's financing costs. You see, when you write a check or pay for something with cash, that money is gone forever. You can't do anything more with the money, and the money you spent can never do anything more for you. That means you're missing out on the opportunity to earn interest on that money you spent. That's the lost opportunity cost that you pay when paying cash. Then there's financing costs. Basically, financing costs include interest charges and fees. And fees aren't always a part of the deal when financing something, but loan interest is pretty much always charged on any loans. And policy loans are loans. And here's where people get confused. When taking a policy loan from with your life insurance policy, you are using your own money, but not directly. You see, policy loans use your money in your policy's cash value as collateral for the loans, but the loans do not take the money out of your cash value. No, the policy loans are funded by the insurance company's general fund. Your money stays right where it is within your policy, safe, sound, and earning that wonderful high compounding dividend interest. That being the case, the insurance company certainly has the right to charge some interest on the loans that they fund, right? Yes. And the loans are leveraging your cash value as collateral for the loans. But the loans are using the insurance company's money, not yours. So again, with the right insurance company, the interest charged for the policy loans will always be lower than the dividend interest that the insurance company is paying to you, and is added to the compounding interest that continues to earning compounding interest. So the interest charged on policy loans is simple interest, while the dividend interest paid to your cash value is compounding. And that does make a difference. And the difference works out to your advantage. As I said, with the right company, interest charged for the policy loans is less than the dividend interest paid to your cash value. For instance, the insurance company I use most for infinite banking charges around 5.3% simple interest on policy loans, and that's an annual simple interest, and is paying 6.1% compounding dividend interest. That looks like just a 0.8% difference on paper, but the actual difference is much greater. Let's look at an example. Let's say we have $10,000 as a loan at 5.3% simple, and another $10,000 earning 6.1% compounding. At the end of 1 year, the 5.3% simple interest charged for your loan equals $530. The 6.1% interest paid to your money equals $610. And yes, that's a 0.6% difference in year one. But at the end of year two, if nothing is paid on the principal and the loan amount remains at $10,000, the interest will again be $530 for the year, but the interest earned on your now $10,610 in the savings will be $647.21, which is now 1.17% greater than the interest charged on the loan. At the end of year three, again, not paying anything on the loan principal, still at $10,000, the interest charged equals $530 for the year. But now the compounding interest paid to the saved $10,000, which is now $11,257, equals $686.68. And that is 1.57% greater than the simple interest charge. Now, in just 3 years, you've paid $1,590 in interest on your loan, while you've earned $1,943.89 on your savings. That's a $353.89 gain over the interest you paid on the loan. And that equals 3.54% gain on or advantage over the interest paid on the loan. And that continues to increase each year. So you see, the gain we just illustrated would be the cost of the lost opportunity you would pay if you paid cash for whatever the loan was used for. In this case, the advantage of infinite banking over standard financing using only interest charges with no additional fees amounts to $1,943.89, including interest paid and interest lost. And that equals 19.44% difference or advantage to using infinite banking over standard financing, even when paying interest on the policy loans. Now, that was an example where using 100% of the cash value equivalent is compared to an equal amount of bank financing. But in most cases, less than 100% of the cash value will be leveraged. So the difference between what is charged for policy loans and what is gained from the dividend interest earned on your total cash value is much greater. So the answer to the subject question of this video, why should I pay to use my own money with infinite banking, is you don't. You pay a little simple interest for the use of the insurance company's money, which leverages your money in your cash value as collateral, while your money continues collecting compounding dividend interest in greater amounts than the interest you pay for the policy loans. And by the way, that small amount of simple interest you pay to the insurance company contributes to the dividends that are paid to your cash value. Now, not all mutual insurance companies charge less interest on their policy loans than they pay to their participating policies in dividend interest. So it pays, literally, to work with a broker who knows how the various insurance companies treat policy loans and the difference between their policy loan interest rates and their dividend interest paid. So if you found this to be helpful, please like this video and subscribe to this channel and share it with your family and friends, coworkers, whoever. Also, please post your questions and comments here. You have questions, we have answers. Now, for a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, we will welcome you to do so. The link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.